Hey everybody, it's Jeff. I want to talk today about how I buy gold, really with the intent of how do we make money if the market goes higher, whereas somebody who likes to collect the actual gold. And I think what you'll notice is if you think gold's going higher, in how do we want to participate if gold goes higher? Oh, well, let's go out and buy some gold coins. Let's go to a local coin dealer. I want to prove to you why that, in my opinion, is a really inefficient method. And I know this will be unpopular in the coin collecting hobby, but I just need to show the math, and the math will tell the story. So let me start by sharing my screen here. Um, so looking at, let's just pretend we have $2,182 to invest. There's a reason I pulled that number out. Current gold spot is $1,910. And you say, okay, my base case is I think it's going to go higher. And for simple math, let's just pretend it's plus or minus $500 an ounce, so about $2,400 if it goes higher over the next year, or $1,500 if it goes lower, which is kind of where we were last year, I guess about a year and a half ago. You say, okay, well, if I have around $2,180 to invest, there's a couple approaches. What most people do is they'll go to the local coin dealer or AppMax, and you say, okay, I want to buy 1 ounce American Gold Eagles. And right now, AppMax has them listed at $2,029. However, spot is $1,910. So right away, you are paying $120 over spot just to buy this coin. That's 6% over spot. So spot would have to rally by 6% just to effectively get to your break even point. And when you sell it, can you sell it for $2,020 is another topic altogether. But let's just pretend I called my local dealer and they said they're paying spot right now for American Gold Eagles. And because I live in Ohio, which has sales tax on all rare coin purchases, including bullion, I would have to pay another $152 just in tax. So my all-in cost would be $2,181, which is a full 14% over spot. That's crazy, in my opinion. And this other method, the gold ETF, GLD, is essentially trading, as you could see here. It doesn't look like the gold price. Gold price is $1,910 an ounce, whereas this gold ETF tracks gold futures one for one. You can see it's backed off quite a bit today, at down 2% at the moment of this writing. But over the course of the year, it will have tracked gold price almost perfectly. And a lot of people believe we're going to see gold exceed the highs if we continue to print the money. Regardless of your opinion of gold, let's walk through why, in my opinion, if I had $2,180 to spend, or $2,100 increments, I would much rather buy 12 shares of GLD as opposed to going out and buying an ounce of gold. So let's walk through that, what it would look like. So looking at the bear case, if it goes down to $1,410, in that case, it's spots down $500. That's a 26% drop. Of course, we all hope it doesn't go there. But in that case, my GLD trade would also be down roughly that much. I would have lost $561. And if we're up 26% on the spot, I would have made 560. You can see it's pretty much an equal swap. The interesting thing too is there is an element of capital gains tax. So actually, if you go down and you lose money, you can use up to $3,000 against your income as a tax deduction, or even more if you have capital gains and other investments. And let's say you lost $5,000 on a gold investment in this ETF, but you made $5,000 somewhere else. Well, you can use that to completely write down your taxes, which would actually net reduce the loss in a falling market. And of course, it does reduce the gain as well by whatever your tax bracket is, or 15 or 20% if it's held for more than a year. But then you say, okay, well, what about this 1 ounce gold coin that I bought? In a market that's down at $1,410, the irony is typically when the market's this low is nobody wants gold, and dealers are actually buying it back a spot or below the spot price. But I'm assuming you can sell it for spot in both cases. And you can argue either way. But if you effectively paid $2,181 in the market, the gold price goes down to $1,410, you would have lost $772. And if it goes up to $2,410, I'm assuming dealers might be paying spot, but actually the last time we hit highs, not 6 months ago, but back in 2009 or 10 or whenever it originally traded up to around 2000 an ounce, as dealers were paying way back a spot because they were afraid of an eventual market crash. So you might not even be able to sell it for $2,410 should we get there. But assuming you can, you would make 228 bucks. And the reason I bring this up is you look at the risk reward ratio here. If the market goes higher, you make less money buying a gold coin. And if the market goes lower, you lose more. So how I do it in my own collecting is, let's just say I have enough money to buy 3 ounces and I really want to actually hold in my hand some gold just because I love holding it. I might go out and buy a ½ ounce just for the sake of collecting and use the rest of the money to go out and invest in the gold ETF to participate. So hopefully you enjoyed this quick call. I just wanted to bring this up because right now gold is moving at a very rapid clip, and I know a lot of people are interested. So thanks for watching. Hit that like button and subscribe if you are interested. Take care.